Unfortunately, nobody is perfect, and as humans, we all make mistakes, which is completely fine. But in today's video, what I wanted to share with you was 7 common mistakes that first-time property investors make. Now, the idea behind this is to help you understand the common mistakes people make so that you don't have to be one of those people. And the end result of that may be a faster journey to financial freedom and hopefully a less stressful journey to financial freedom. Now, I've been fortunate enough to talk with over 2,000 investors over the last 5 years, with a large portion of those being first-time investors. Now, the first mistake that I see a lot of first-timers make is they overestimate their initial deposit for their first property, because a lot of people believe that you need a 20% deposit of the purchase price to secure your first home. Now, it's always recommended to go talk with a bank manager or a mortgage broker to see the different options that could be available to you, because when I purchased my first property, I actually only had to put down an 8% deposit, which enabled me to get into the market sooner and start reaping the benefits of that capital growth a little bit sooner. Now, had I waited until I had a full 20% deposit, the market would have risen significantly. I would have had to pay a much higher price for the property than the difference between the 8 to 20% deposit. So definitely go talk with a bank manager or a mortgage broker to figure out exactly how much you need to purchase your first investment property. Now, the second mistake I see a lot of investors make is they don't come in with a plan or a strategy. A lot of people, because they overestimate how much money they need, they go see a mortgage broker or a bank manager and find out that they're actually in a much better financial position than they thought, and they're ready to buy a property. What happens from here is people end up rushing in and they end up making some mistakes there. So like everything in life, there is a process to follow, and with the right plan, with the right strategy, it can make it a lot easier to execute that process. So sit down, have a think about where you're at right now, where you want to be in the future, and the idea is to bridge that gap on the path of least resistance, hopefully. The third mistake that I see a lot of investors make is they end up buying in their local area. Because Australia is a huge market. I believe there's over 13,000 different suburbs throughout Australia. It can be very tricky to figure out which suburb you should actually be identifying and purchasing your investment property. Now, as we all do, we like to stick in our comfort zone, and the local area that we've grown up is obviously within our comfort zone. This is where we've heard the most success stories. This is where we've grown up, so we understand the good pockets, the bad pockets, and we know how to transact in that local area. So it's really, really common that people do this, but it's important to recognize that not always is your local area the best area to invest, because what we're trying to do as investors is generate the best return on our investment while we hold that property. And you need to make sure that you're purchasing the right assets in the right market at the right time. Now, for some fortunate people, when you are purchasing your first investment property, it may be in your local area. And that's super convenient because it will make it a lot easier. But for all of those people that are forced to invest in other areas than their local area where they've grown up, it can be a little bit more tricky, and that's where you need to do the necessary research and due diligence to ensure that you're not making any mistakes and that you are capitalizing on that purchase to get the best return on your investment longer term. Now, the fourth thing a lot of people do is they end up purchasing units for their first investment properties. And this is because units generally come at a more affordable price, and a more affordable price means less debt, and sometimes units generate a little bit more cash flow. On top of this, some of the people that are selling off the plan units are some of the best salespeople in the world, and they make it seem like it is the best decision for you. But as investors, we need to make sure that we are learning about how the market works and what particular assets perform best in markets. Now, we've done some of that research, but there's resources out there, people and companies like CoreLogic, RP Data, that have done studies where they've looked at the comparison between houses and units in Australia. And what they found is that over the last 25 years, houses have outperformed units by 97% in Australia. Now, to get the best return on your investment, you want to make sure that you've got the best asset. So purchasing houses on large pieces of land could impact your longer term position, could help you get a better capital return longer term. So you want to make sure that you're purchasing houses on big pieces of land. The fifth thing that a lot of people do as well as first time investors is they end up purchasing house and land packages. Same thing goes with the off the plan units and units, they can look flashy, and the people that are selling you house and land packages are very, very good at their job. But sometimes the fundamentals of a quality investment grade property do not line up with some of those house and land packages. Now, I understand there has been some amazing results from house and land packages, and I'm not saying that it's the worst investment out there. I'm just saying that there could be better options out there for you. And I heard a statistic recently that 60% of investors actually lose money in the first 5 years. And that's because a lot of people purchase these house and land packages and the off-plan units. Now, you've got to remember that the world revolves around money and everybody needs to take their cut. So when you're looking at these house and land packages, the builder needs to make their money, the developer needs to make their money, the person selling it to you needs to make their money, and they're all adding their commissions on the purchase price. I've talked to a lot of people where they've purchased a house and land package at a certain price, and upon completion, their valuation has been lower than what they paid for that deal. Now, more often than not, the difference generally is the commissions that the developers, the builders, and the salespeople are taking from them. So you don't want to be paying everybody else's wage all the time. Sometimes you need to work smarter, not harder, to actually capitalize on the opportunities. And just because it looks good, it doesn't mean that it's the best thing. Sometimes a gross, ugly renovator can be the best investment for you, because rather than paying the premium for the beautiful brand new home, you're buying in a good area and you're buying something where you can actually add the value yourself. Now, obviously that requires work and money and time, which can be challenging, but it can also help you speed up that journey to financial freedom. Now, the sixth mistake a lot of first-time investors end up making is they actually overpay. This is a very, very, very common mistake that a lot of people make. It is really important to understand the local market that you're investing in extremely well. You need to understand the recent sales, you need to understand the recent movements in the market, and you need to understand exactly where market value lies for each and every opportunity, especially when operating in a hot market. You got to remember that a lot of real estate agents are extremely good at negotiating and are extremely good at sales. It is their job to get the best result for the seller. And what they're trying to do is get your price up. Now, we've bought a number of properties for a lot of investors over the years at Pumped On Property. And one of the things that we have to do is make sure that we understand where market value is, make sure we understand exactly how certain agents like to negotiate, so that we're making sure that we're not overpaying for ourselves or our clients, and to make sure that we are getting that property at market value and never above market value. So once again, just doing your research, planning, developing out your strategy can help. Avoid making those mistakes and just understand that the sales agent is working for the seller, not for you. Even when they feel as though they're your best friend, they feel as though you get along with them extremely well, they're still incentivized to make you pay a higher price. So it's good to be aware of that. Now, the seventh mistake that I see a lot of first-time investors make is they end up taking advice from the wrong people. Everybody has an opinion about property because in Australia it's been such a top performing asset. And there's generally stories on both ends of the spectrum. There's generally success stories from people that you'll hear that have done extremely well. And there's also, failure stories where people have purchased certain assets in certain markets and either received negative growth or not much growth over a long period of time. Now, as we've talked about, Australia isn't one big market. There is markets within markets, and each of them represent different opportunities at different stages of their investment journey. So a lot of the time, those success stories, maybe they bought at the bottom of the market and sold at the top of the market. Or those failure stories, maybe they bought at the top of the market and they missed out on all of that growth, and they're expressing their biases towards you based on their personal experience, not based on history, not based on data. So you need to make sure that you peek behind the curtain. You're not taking the emotional advice from somebody that could be biased towards that type of investment, and you need to make sure that you're looking at the data, You're looking back in history as to how that particular market has performed. You're looking at where it could be at in its current stage of the real estate cycle to capitalize on that. Now, we always want to try and buy closer to the bottom of a market rather than the top, and you want to make sure that you're experiencing that growth cycle, not purchasing at the top and then not receiving anything. And the sad thing about this is a lot of people only finally get the confidence to invest in a market once it's already been through their growth cycle. And this can really dramatically change the motivations and the thought process around property investing. So it's important to make sure that you get all of these things right. So now that we've gone through these 7 mistakes that a lot of first-time investors make, please take notes. Please make sure that you avoid making any of these mistakes, because it will make your journey to financial freedom a hell of a lot easier. Now, if you're sitting there thinking that you're ready to purchase an investment property, or you're in the planning phase of purchasing that investment property, then we would love to offer you a one-on-one strategy session. Now, you can head over to our website, pumpedonproperty.com, and follow the links to book in your free strategy session, where we'll talk about where you're at right now, where you want to be in the future. We can educate you about the current market and different opportunities that may be of value to you, and then you can take that information and go and smash it yourself, or you could become one of the small number of clients that we work with each month, and we can hold you through that process of purchasing your first investment property to avoid making any of these beginner mistakes. But anyways, thank you so much for listening, and also, as always, stay safe when you're investing.
Woo!
That's a wrap.
That's a wrap.
Getting
Have a
cool,
spin.
bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that.
So nice, eh?
Oh.